All right, good afternoon, everybody. What's up? Well, let's jump in and we can take a look at Zoom. I'm an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA SIPC. All of my trades are placed through T3 Trading Group, and you should carefully consider whether trading is suitable for you in light of your own financial condition. The position disclosure. Oh, I'm trying to get out of a position right now that I did not mean to keep. But I've got to put it on here, Neo. Trying to get out of that. I got out of Tesla. That's an update. I got out of that on Friday into the down move at my target. It was a good trade. Pat's still connected on the VTF. Hold on. I think I can boot him. Stop that screen. Bring everyone here. Can you see my disclosure now, Eddie? Cool. I was short intel a lot today. I was very borderline on keeping it or not. It's so extended on the daily chart, but I decided not to. I have a bunch of TQQQ, I have a bunch of UPRO. I'm keeping more TQQQ and UPRO than my game plan actually calls for, which is not something that I recommend people do. What I always recommend is that you follow your game plan, always, no matter what. Because it's really the key to success and consistency in the business. But I don't know, market's getting a little bit silly. I was also getting a little bit on tilt, which I'm happy to talk about. I actually think I traded pretty well off the open. The first half of the day I traded really well. The second half of the day I traded really poorly, but I didn't lose any money from trading poorly, which honestly isn't always a good thing. So anyway, we got Zoom here. Zoom here's up 10% right now. Third quarter revenue beats. Their revenue guidance here is a beat. Their adjusted EPS fiscal year guidance is a beat. Solid. Zoom not too bad. Gapping up pretty nicely here. Maybe that helps give growth a little bit of a boost tomorrow. I know it's one of, like, I think it's like a top 3 or top 5 holding an ARC, right? But yet ARC's not upticking too much after hours, 8 cents or so. All right, so the market today is Monday, November 20th, holiday week, Thanksgiving week. The S&P closed up 0.7%, the NASDAQ closed up 1.2%, and the IWM closed up 0.56%. I think this is the cause of a lot of my frustrations here. It's less the market moving up and more the way that it's moving up. The TLT is up 0.5%. TLT's up 0.5%. This market really, it was already trading higher, trending higher, trading higher throughout the day. We pretty quickly in the NASDAQ and the SPY has got above Friday's high. The daily chart here for the market has been bull flagging, but it's still pretty extended. So 3 days of consolidation, the ADMA has not caught up to the base of the bull flag. That is usually when you get bull flag continuation, is when the ADMA catches up to the base. This market's so strong that it broke early here, which is really impressive. Yet at the same time, we aren't surprised to see this based on what we discussed in the morning meeting. This morning we were once again in a difficult spot where shorting is difficult because we were extended but not extremely extended. It's more into that extreme extension that you can feel more comfortable with the short. Yet buying here was also very difficult because you are still extended. So it's still that like bad risk reward on either side. So we discussed that you could easily see this market rip up to 455 today. And what's the high of the day? 455.12. We also discussed, though, that this market could price correct down to 446, and it would actually be a shallow price correction. And it's also starting to become notable just how wide this spread is between the 8 and 21 EMA, which really adds to that extension I'm sure you could. For me, I've just kind of adopted a pretty simple approach here and how I've been utilizing extension and extreme extension, where every time we are $10 plus away from the ADMA on the daily chart in the SPYs and the Qs, either the upside or the downside, it makes a lot of sense to come in the other direction. But really, an extra piece of information that you should work in there also is how far away the 21 EMA is, how far that spread is, because as that spread increases, $10 of extension from the ADMA is actually even more extension than $10 of extension from the ADMA if the spread between the 8 and 21 is increased, if that makes any sense. And that's pretty much exactly where we're at. So the market move here is becoming extreme. The difference that we're starting to see now, though, also, especially like a major difference between where we were at on November 3rd, and I'm curious to see the updated Goldman data tomorrow morning, is it seems like a lot of the positioning is starting to get cooked a little bit, to the point where, again, I'm still bullish here for November and December, but I laid out a thought process in the morning meeting today, which was immediately proven wrong today, that the rate of acceleration up in the market should slow down, that we should be able to go into more of a normal uptrend if the trend continuation is going to happen. And that's just because I think that, back here at those October lows, positioning was starting to get a little bit extreme in the other direction. For example, just with the CTA data, with how short they were and how much buying they were going to need to do over the course of the first 2 weeks of November, that pretty much all played out exactly as we thought. But now everything is normal, or potentially even starting to get extended to the upside. And I know Dimitri at about 3:30 today posted a couple of interesting charts here into the VTF. One is this, I just scrolled up to 3:30 to find it. One is this NASDAQ 100 net long futures contracts. That number, I'm not familiar with this chart. I don't really have experience with it, but if I'm reading it right, that number is bigger than any time it's been since the last couple years here, since June of 21. So positioning is getting cooked there. He also provided a CTA positioning, which I'm not sure if this is just a metric of overall buying. I think it's more of a metric of, I see it here. It's the rolling 10-day change. Yeah, that makes more sense to me. So the 10-day change from the CTA buying is also massive, which does not necessarily mean that it needs to stop. But I was also in the morning meeting quoting from Pat's note a couple pieces of data that I thought was interesting. Again, it doesn't say that the market needs to stop moving higher. It's just that I think that if we move higher, my thought process is that if we move higher, it's not going to be in the same way as what we've seen so far for the month of November. And you can see that here once again, the CTA positioning. This is kind of back into more normal territory, right? It's not like it was at the July high, but it's also not negative like it just was at the end of October. And then this Goldman positioning, which this thing can stay, you can see it back here also in like the June-July period, where positioning was stretched to the upside for just multiple weeks or even months before it actually pulled back and the market pulled back. But for the first time here, we're starting to get up there. So again, this is all information that doesn't mean that we can't move higher. And again, I'm bullish on the market. It's the way that we're moving higher at this point is starting to become a little bit of a conundrum to me. And particularly, honestly, the outperformance of the Qs. Look, I get it. I understand that the Qs outperform. I know what it's composed of. I know how market cap weighted indices work. I get it. I just thought that, given my thought process, and I might still be right, but the timing could be wrong, and that happens a lot. And that's why it's so important to manage your risk, because in trading all the time will be right, but the timing can be wrong, and you need to manage your position sizing and your risk and everything else. But I really thought that given the spread in performance between how the Magnificent Seven and the other 493 stocks has been so far this year. Plus, part of that I really think has been because of the interest rate environment. And, Apple and these stocks that have a lot of cash, or they've got a lot of like long duration, really cheap debt on their books, it makes sense. And we've spent a lot of time here in our afternoon meetings citing Microsoft as an example of why I have been saying that the Fed needs to stop raising rates, is because you're creating this universe of haves and have-nots. You're really going to make it so that the rich can get richer and the poor can't, to a certain degree. Whether you're looking at big companies versus small companies, or I think whether or not you're looking at individuals. And I know that the labor data actually all shows that recently, here over the course of the last couple years or whatever since COVID, that it's actually been like the biggest catch up that lower income people have had in a long time. But I think that you're going to see that fall off a cliff if interest rates stay really high, and older folks who already own their home and don't have a mortgage are going to be just sitting on piles of cash that they're getting 5% interest rates on. And young people that are in household formation years who are getting 8% mortgages and don't have that type of cash, and they're putting 5% down on their mortgage, are going to be in trouble. And or you look at Microsoft, and Microsoft is locked in at 2%, 3% debt on 30-year pieces of paper, versus the big chatter out there has been the reason for the IWM weakness, the reason for small cap, mid cap weakness, the reason for non-profitable tech, growth tech weakness, is because a lot of these companies are going to hit like a cliff, basically, where their debt that they were able to take out when interest rates were so low isn't dated as long as a Microsoft or an Apple. And in really, I think starting in 2024, but probably more in 25, 26, if we are truly higher for longer, which we'll see if that happens or not. A lot of those companies are going to have to refinance. They're going to have to take out more debt, but they're going to have to do it at interest rates that are potentially so much higher than what they already have, that you then wonder if a lot of those companies, maybe some of them, can't be going concerns. So the interesting discussion, I think, from a more fundamental perspective, is that you can look at your Apples and Microsofts of the world, and you can say from a fundamental perspective that these companies are expensive right now. That they're a little bit expensive compared to how they normally trade historically. They're probably a little bit expensive on an absolute basis. But the argument that I was making when we still had the TLT dropping was, well, probably makes sense that these companies are a little bit expensive because of the interest rate environment, because people want to pile their money into that degree of safety. Obviously, there's also the AI chatter about how they're going to just monopolize the growth in AI because of how much money they can put behind it. So all those reasons, you can have Microsoft and Apple trading more expensive, and also a lot of these IWM companies that are trading at really cheap multiples. Maybe they're trading at cheap multiples for a reason, because again, their debt's going to fall off and they're going to have to get more debt at significantly higher rates. But then if that's the logic, then I would really think that into this TLT move, and we have seen it in fits and starts, but we certainly didn't see it today. I would think that into like this TLT move here at 1 o'clock, when we ripped higher on the bond auction, that where you would really get the outperformance would be in the IWM, and if anything, I would think that you can get some rotation out of these more safety plays that are the Magnificent Sevens, that are the Apples of the world. Let me pull some of my cash that I threw into Apple because I knew it was safe, and invest in some things that are going to be a little bit more risky, because now the market, and I actually don't think this is going to happen, but the market is pricing in interest rate cuts for March. And if that's true, then all of a sudden maybe your concerns about a lot of these IWM companies not being able to be a going concern because they can't survive at higher interest rates, maybe some of that concern kind of goes away a little bit. but that's just not what we're seeing, and I think that's where my frustration comes into play on today's trading session. Like, I really can't be mad. I closed green today, though. By not I was up a lot more at one point or early on in the trading session, but I can't be mad. I came in by the end of last week again. I was back to being net long, even though it was by a smaller amount. So I came into today as net long. I was up money pretty much all day today, though there was one point in the afternoon when the Qs were making highs that my P&L flipped to red for the first time all day. But I'm frustrated because I feel like at this point I'm out of Apple and Microsoft in those names. They hit my targets, I followed my game plan, and I got out. And I'm trying to be short the SPYs and the Qs to protect myself from this extension. And I've got a bunch of stocks that I'm still long. And yeah, those long stocks are going up for the most part, except for SoFi, because the market's going up by so much, but they're just really, really underperforming. So I'm like building into this extension still and following my game plan on the SPYs and the Qs. I'm doing exactly what I discussed last week, where my game plan is really based off the ADMA. My short and UPRO and my short and TQQQ is I'm managing it versus the ADMA. So what that has meant is that each evening into the close, I've been liquidating a bunch of stock because I know that means the next morning, because it's moving average and it's just simple math, this moving average is going to be even higher, so my target on the SPYs and Qs is less, so therefore I need to have less stock. So I've been selling some almost every day into the close. Then I'll short more stock in the UPRO and the TQQQ intraday as the market moves higher, and I'll work the position back and forth, and I'm making decent cash flow by working the position throughout the day, and then again liquidating some into the close when I don't get that heavy sell-off into the close, because I know that moving average is going to be even higher, because as we continue to move sideways, it just enables this ADMA to catch up even more. So that's kind of been the game plan. It's been working really well, considering what this market has actually done. I am down on it, and if I end up closing out the positions down, which is starting to look a little bit more likely, it'll be the first time in the 2 years that I've really been doing this where I'll close out a position negative that started because SPYs and Qs were $10 extended. That trade has worked for me every single time in the last 2 years, and this is the first time that it might not work, and that's obviously for obvious reasons. But I feel like I've been managing it really well by taking off some stock, even though it's been for technically a loss, into the close on most of these days, just because I'm managing to that moving average. So it's like selling my longs into the up move. I do get heavier into the up move as well for the indices, but then I take off some of that heaviness into the close to make up for the fact that the moving average is continuing higher, and that's enabled me to, in the more extreme spots, like again on I think on the 15th, I was out, I think on both the 14th and the 15th, I went home net short, but then by Friday, when this moving average was able to catch up further because of the further time correction, was able to take off enough that I was actually back to net long coming into today, if that makes sense. Just telling you guys exactly what I'm doing. But the frustration really just comes from this massive outperformance in the NASDAQ at this point, in particular, and these 7 companies, where it's like, man, I've been so bullish on this market, and I also can't complain because that first week in November was one of the best weeks, if not the best week I've ever had in my trading career, because I was so heavy at the end of October. Told you guys about it. Like I'm going all in because of what the flow of fund information was telling me. But at this point, it's like, even though I still did manage to close, kind of green on the day, and I shouldn't be complaining, I was hitting a point intraday today where I was pretty much on tilt. And I haven't felt that way in a while, into the afternoon. And I know myself well enough. I know it. So I'm communicating to you guys that I'm trading. I'm also communicating to you guys, like, I very specifically said it, and it happened to work. I'm not going to say it's good trading. When the SPYs and the Qs really started kind of going parabolic into these 3 bars here that culminated with this maximizing volume at 1510, it was one of those, like, I was starting to feel so frustrated, but I am also seeing the price action where I'm just like, oh, F it, I'm just whacking my market sell button here and just hitting the bid and taking like a lot of size. And I ended up doing that with both T Triple Q and U Pro, and it turned out to relatively be the top. But that's not good trading. It's really not good trading. I tried shorting the market on 3 different occasions today. The first trade was pretty decent. It was this call out right here when we had this shooting star forming at 10:05 with that tail through. It was very early on that call when we pushed through and came back down. Got the full 15-minute correction. That was nice. I made okay money on that. The second trade I called out was the short off this 1:10 p.m. bar, and that one I didn't get my 1-to-1 kick by a penny or two, I think, at that low, so I got stopped out for just a straight loss on it. And then the third one was when we were going parabolic here. There really wasn't a signal. It was just honestly me being frustrated, seeing that the market was going parabolic, seeing how extended we were getting on the daily chart, and I basically told myself, and again, I'm trying to caveat this by saying this is not good trading. This is what I did. I basically said screw it. I whacked the bid, and my game plan for it was I'm going to liquidate what I just shorted at the close, and that was it. So no stop loss, nothing, no risk management on it. My only risk management was time, knowing that at that point I've got less than an hour on the day. So yeah, we could rip to 393 if we want to, and I'll be totally screwed on that position. But my risk management, if you want to call it that, is really just time. I'm not going to really keep much, if any, of all this extra stock that I'm hitting. And then it did end up kind of being the high of the day. And like Pat said, sometimes those trend following algorithms, they book profit into the close, they book profit into the end of the day. So we did get this rollover into the close that enabled me to cover a lot of U Pro and T Triple Q. But what I didn't do this time that I've been doing every day, which is a deviation from my game plan, which we'll see if it comes back to bite me in the butt or not, is cover the extra stock, right? Like I manage that every day. I've been covering. I said that every day that as I've been covering more spies and Qs into the close to make up for the mathematical fact that the ADMA is going to be higher the next day because price stayed higher during the course of that day. I didn't do that this time. I didn't cover any of that. So I'm keeping like a good amount of extra T Triple Q and U Pro short. It's got me. I haven't actually done the math, but I mean, just eyeballing here, I'm very clearly net short again tonight, which might come back to haunt me. Today technically is a day one breakout of a bull flag. Usually you don't end after one day, so we could be higher tomorrow, and then I'm gonna have to make potentially a hard decision into Nvidia tomorrow, because Nvidia is gonna move the Qs in a big way, and the amount of T Triple Q I have right now, it would be borderline irresponsible to gamble into the Nvidia report, even though my inclination is that I don't think that there's any way that Nvidia is able to repeat what it did back here in May. I'll start by saying that. That's my inclination. Anything can happen on an earnings report. And I kind of also agree with what Pat was saying a little bit when he was on the radio and in the close, where he was saying I can envision a situation where Nvidia's numbers are actually pretty good. The stock trades up on it, it gaps up on it, but then they actually sell it the next day. I don't want to speak for Pat, but I think that his reasoning behind that is just that the move in this Nvidia and the expense on this Nvidia is so much at this point that you could easily, and we've seen it happen many times, where there's so much hype around something that even when the numbers actually come out and they're decent, they might gap it up really big, but by the close that next day, you see it red. I like that thought process. I think it's an accurate, and that's assuming that the numbers are actually decent. But with that said, it would probably be irresponsible to still be as heavy in the U Pro and T Triple Q shorts as I am right now. into the close tomorrow, but I'll assess that as it comes. So that is all I've got. So there were some other good trades today that I almost forgot even happened. XPEV was a great call this morning. We said long versus 17. I wasn't able to get super heavy on this one pretty quickly. Intraday, we were able to raise our stop to lows. Neo was also really good. We said Neo long versus $7.50. That one worked out really well. Pretty quickly, we were able to raise our stop into the close. I'm still trying to liquidate that position on the offer. Forgot that I was in it. Yeah, so those are pretty good. Kind of went over the market trades a little bit. The first Intel trade was pretty good. This short in here with this extension followed by this inside 5 and down. That was at the same time that we're looking at the market short there, but then this also turned into an upside grind. I really thought about keeping Intel short as it's on day 5 today, and it's like the most extended of the upside that I've ever seen Intel be. I've never seen Intel trade like this. It's trading like it's the 90s again. The 90s are back. But I decided, given how heavy I was in UPRO and TQQQ, that it'd be irresponsible to keep this also, and I finished up a very tiny amount of money in it by the end of the day. So I just said, you know what, I'm just going to close this position. That's all I got. I'm happy to take a look at what you guys have or any questions that you may have. From Eddie Vic, I agree. I don't think NVIDIA will have another up over 15%. The implied move as of today is 7.5% up or down. Thank you, Eddie. Dimitri saying, but the extension away from the longer time frame 21 EMA, it makes today's bull flag breakout susceptible to a fail. I agree 100%. I agree 100%. And that's why I think I was fighting it at a certain point also, and that's why I've kept more stock out. We're so strong. This doesn't happen very often, and it also, and I agree with you about your comment on the 21 EMA, but even when you have the 80 EMA not caught up to the base, that's when you're supposed to get continuation. When you happen early like that, it's a higher probability that this is could become a breakthrough failure. The extension from the 21 EMA, that's what I said in the beginning of the conversation about how, like, yeah, I like to consistently keep it simple and just measure where we're trading versus the 80 EMA. But at a certain point, when you get a real widening of the spread between the 8 and 21, you have to recognize that $10 of extension, if we get $10 of extension here, it's not the same as $10 of extension here, honestly. You're even more extended because that spread's becoming so wide. And I think that also leads to a higher probability of a breakout failure. But the underlying bid and the underlying demand in this market has just been incredible. And that's also why I thought that, yeah, we can continue here into the end of the year. We could make new highs on the year. I think it's possible. I wasn't expecting that we were going to be able to have this degree of extension still within our consolidation pattern and just immediately go again today, which we know Mondays have been consistently very strong, and this was another really strong Monday. But, I mean, the degree of strength here, I've been trading for a long time, and I'm trying to remember a market up move that was like this. Like, I've seen the market move down, like what the way that we're seeing the market move up plenty of times. But I'm not gonna say I've never seen the indices move up like this before. I'm sure I have. Certain points of that initial post-COVID low period were, similar in terms of how vicious the up move was. But what we're seeing here in the month of November is also something special. It really is. This is wild. And again, that's why I can't be upset if I end up closing out my UPRO and my TQQQ positions with a loss, which again, I'm managing them to the 80 EMA on the daily chart. If I ended up shutting them out for a loss, which as of right now, it's looking increasingly likely, I can't be upset by it. It's been a trade that has worked every time for 2 years, but I know that the market is in probabilities, and even though it's a trade that's worked every time for 2 years, it doesn't have to work every single time. So we work in a universe of probabilities. I would not go back and change the way that I treated those trades. I actually think that I treated them perfectly, and that 19 times out of 20 or even more than that, I'm going to end up making money doing exactly what I did with the market shorts that I have on, which are also acting as some degree of a hedge to the longs that I have on. It just so happens that here in a lower probability, like borderline historic few weeks, just with the way that we've moved up, it's not going to work. And there's always a probability that can happen in the market. Anything can happen in the market. If you're trading long enough, you'll see it. So yeah, that's where we're at. From Cameron, having trouble adjusting my trading when the market environment changes. That's one of the hardest things. Can you talk about how you determine when you are looking for longs versus shorts, and when you are looking for momentum versus entering on pullbacks? Sure. So it's a broad question. I'll try to tackle it kind of one step at a time here. So you're struggling to adjust your trading as the market environment changes, and the first thing I would let you know is that you're in good company. From my experience, for even really successful traders, that's the most difficult thing to do. As a trader, you get comfortable with what works for you, and all of a sudden, when something doesn't work for you because the market changed, it's very difficult to change what you've been doing in the past when what you've been doing in the past is successful. It's difficult mechanically, it's difficult psychologically. You almost have to build new habits around the new normal for the market. So how do you adjust? The way you adjust is by really keeping your finger on the pulse of the market, by honestly staying up to date with the current events that are the market dynamic factors that affect how our market trades. Like, I think that we did a really good job. So just using one example, there's no doubt in my mind that this advent of zero DTE options trading has changed how the market is traded. Particularly how it's changed how the market is traded on an intraday basis. And it's actually changed the market on an intraday basis in a way that could be very frustrating for me personally, based on how I trade. The way that I've always loved to trade, and I know that this is the way with a lot of you other guys who I've spoken to who are experienced, successful traders who have been doing this for a long time, who have been struggling a little bit more recently. We like to trade the open. We like that morning momentum rush when the market is thinner, and you're trading that breakout, and you can take size on it, and you can get follow through. And then midday market trading comes around, and you're not really paying attention to it because that midday is difficult, and then maybe you trade the close a little bit. And then this environment, and I really think it's because of zero DTEs and how they're putting the positions on in the morning, and then they're covering those positions into the close because they're 0 days to expiration. And that afternoon session is when you're just getting a lot of unwinding of zero DT options that were opened in the very beginning of the day, has been leading to a lot of these sloppier, weaker openings, particularly for people that trade the way that I have always kind of traded at the beginning of the day, where I've spoken to a lot of really good traders, even recently, who say, I'm so frustrated because my ideas keep working and I keep getting pushed out. And I'm like, well, I can tell you exactly what the issue is, because the market's changed. You're getting too heavy too early, and you're not giving enough room because you want size for the early momentum move off of your idea that you game plan and researched in the meeting, because or in the pre-market, because that's what you've been doing for the last 10 years, and it's been working great. And now all of a sudden in this environment you're doing the same thing. You're getting pushed out in the first hour of the day when the market's being sloppy or rounding down, and then next thing you know, it's lunchtime and new highs are coming in and the market's grinding up, and you're sitting on your position, on no position, and you're sitting on with a big fat loss from what you were doing off the open, and the adjustment that you need to make is sizing and space. It's less size early in the day and more thinking about keeping your idea intact, but building into the position in the beginning of the day, being a little bit lighter, being a little bit looser, getting a little bit more size in the beginning of the day until the market really proves that the idea itself is wrong, and then actually being the beneficiary of that afternoon kind of roll up. So I mean that's just an example, and I only know that because, well, one, I trade and study the market every day, but it also just has a lot to do with the data, the data and the information that we read every day. And that's, by the way, I can't emphasize this enough. And every once in a while I peek in to see, like, you can see in the top right corner how many people are like reading Pat's note at once. I know a lot of you guys don't read this note every day. You're doing yourself a huge disservice if you don't read Pat's note every day. I know it's not going to teach you how to buy Apple tomorrow and make money in it from an execution perspective, but if you read that every day, you learn how the market itself works. And again, that's not going to help you on your day trade tomorrow, but it's going to help you understand like the strategies that you need to implement, and it makes the market movements make sense. Like, there's a lot of other smart people I know who are pulling their hair out because of this November market move, because they're expecting the recession, the fundamentals, and again, they may well be right, but we were able to be all over this up move just because we were looking at the data, the flow of funds data that was coming in and the market positioning data, and that, by the way, has also just been a major key to the business. And I think that goes to one of your other questions here about knowing, when do I focus on longs versus when do I focus on shorts. The answer to that question, first of all, you have to break down. You can't just say longs or shorts. It's longs or shorts that are with trend or counter trend. So it's not two categories, it's four categories. It's with trend longs versus counter trend longs. It's with trend shorts versus counter trend shorts. And where those bigger market pivots might come in. And once again, the data has really come down to, knowing what to do there has really come down to the information that's coming from Pat's note that we're seeing every day. I mean, guys, I can't emphasize this enough. And I struggle with this. I want to get on conversations with a pro trader, with Greta, the next time she invites me on, and just honestly get up there and be like, I'm awesome. Because of the way that we've called the macro on this market environment this year. I haven't seen anyone, no one call the big picture market swings the way that we've called the big picture market swings this year on our team. Nowhere else on all of Wall Street have I seen it. And I'm look, and again, I always try to be fair and balanced with what I say. I'm not a perfect trader. I make mistakes all the time. Sometimes I'm even right, and I lose money or whatever it is. But we were super bullish at the beginning of the year. Caught the move. We got more cautious. Then we caught the bottom. We caught the breakout. But every time it was in the data. We knew how underpositioned everyone was at the beginning of this calendar year. We knew what the data also looked like with underpositioning in May when we were in this consolidation, which is why we felt it could break out. Then literally we called the exact top in the market to the day at the end of July that was based on a combination of positioning and technicals, because the positioning had completely flipped to the other side. Everybody was bullish, everybody was over positioned to the long side, and then we got this push through failure on the 27th, which is when we said that was it. That led to a multi-month correction, and then finally at the end of a multi-month correction, well, first of all, on a smaller time frame, we got super bullish at the literal low day in August, and then we did the exact same thing at the end of October. And all it is, again, is the data in Pat's note. That's it. So a lot of what I'm doing when I'm telling myself, how should I be positioned in this market right now, long side or short side, it's a combination of, well, what is the data telling me on how I should be positioned? Is it extreme or is it in a midpoint? Most of the time you're in a midpoint, right? Like most of the time here, like we knew that it was a little bit extreme in terms of how people were not properly positioned for a rally back in May. But then as this rally was coming in, the positioning was increasing, but it wasn't extreme until the end of July. So you're at the midpoint. You should just be trend following primarily throughout this period of time. And then when it got extreme in this way and it broke in the other direction, it's really the same thing. You honestly should have been primarily trend following to the downside. I know it was not always easy because there were some big up moves and we were able to take advantage of those as well. But in the mid periods here, you want to just be trend following, big picture. And then other point, and then once again, we hit an extreme readings at the end of October that had us start thinking to the long side. And what's been going on over the course of the last few weeks, the positioning in the market has been repositioning itself. And throughout most of that, and I know in some ways it's been difficult because the market's just been vertical here, you mainly just want to be trend following higher in this market. Now, within the confines of that information, though, there become periods of time where you want to potentially come in for a counter trend move or lighten up on your with trend stock. And for me, those readings have been, is it a day 4? Is it a day 4 with $10 of extension? It's like, okay, I wasn't confident by any means that August 18th was going to be the low of the summer. The data, the big picture data that I keep pointing to did not say that. But I knew that as this market was unwinding from the extreme period here at the end of July, when we got to this mid-August point, it was more neutral, but we were a day 4 gap down into just about $10 worth of extension. So here, still probably bigger picture, you want to be short versus long, but the extension got so extreme that we could look the other way for a trade. And then sometimes retracements can become reversals. And honestly, it was back in September here at those highs with this lower high where it looked a little bit different again. So it's combining technicals and data, if that makes sense. So the data really, I think, is helpful on these more major turning points in the market. The flow of funds data, the positioning data, all of that stuff, and then it's the technicals of combining trend following with extension, right? Which is why it's like, just to recap November briefly, which in some ways has been a difficult month, even if we've been super bullish, just because, again, like this is better. This is going to be better trading, like what we had in second half of May, June, July, where you have an uptrend, you have higher highs and higher lows. This is actually better trading. This gives you more opportunities to be able to get involved in the market, to come in and to buy, or then to sell extension and rebuy stock and all that. This market has just been straight up, and what we keep waiting for is like, okay, we're watching the data become like less bullish compared to how it was at the end of October, but we're waiting for the trade setups while we're in the middle period where you just primarily want to be a trend follower. And the problem is that we haven't really been getting many setups. We had the setup that came into the market from that Thursday sell-off Friday buy, which I even recognize that Friday gap up, but if you didn't get involved pre-market, actually made the long entry there more difficult. But this was the only time this entire month where the market actually gave a real setup where you weren't extended, and you could say, okay, look, I can look to buy this dip, if you even want to call it that, buy this bull flag, maybe is a more appropriate way to call it, or by this time correction, because the market just went sideways for 5 days. It's very bullish. The flow of funds is still bullish, and the ADMA has now actually caught up to price. And I feel like a broken record in the morning meeting, and I don't like being a broken record in the morning meeting, but I think it's the right information. Where almost every day we're coming in, and I'm like, okay, guys, we're too extended to buy, we're not extended enough to short. Like, how many times have I said that this month? There's been some days where it's been the opposite. You know, a couple days here where I really like shorting, a couple days here where I really like shorting. The market's been so strong. Again, this goes back to flow of funds data that didn't amount to very much. And then on this, Friday, it was the one day, like this entire month, where I said, okay, the setup is here, where we can actually we can do a lot of buying and coming in on this market. But that's also, by the way, why I'm a big believer in a top-down approach to trading. It's big picture down to small picture. It's not small picture up to big picture. The big picture tells you how you want to trade. The small picture tells you how to do it, basically. And if the big picture is lined up, then it's like, all right, let me look for this small picture for execution. And otherwise, you try to pick your spots. Like, there's a lot of these other days where even if the market's kind of in no man's land every day, we can find an XPEV or a NEO or one of those names where we can try to come in and take those trades and make some cash flow for ourselves. And we do a pretty good job finding those day in, day out. Not perfect, it's difficult, but I think pretty good overall. And then another part of the environment is answering the final part of your question. Like, when do I trade for momentum versus when do I look to build it in pullbacks? It's also going to be where you are in that market cycle. Like, I remember very vividly in April and May, momentum breakout traders here being super frustrated. But if you were kind of buying the intraday dips and taking advantage of that zero DTE market dynamic, this was actually a fine period, and you were able to just work those ranges. But then when the market actually broke out in second half of May, June, July, there were plenty of great breakout momentum trades where you're basically just looking for trend and momentum continuation, and the market's telling you that you can do that. So that's part of it also. From Cameron, to follow up on that, if, for example, we were in a strong market like we are now, would you avoid shorts even if it's an in-play stock gapping below support? So while the market is always a layer of probability for any trade that you take, it becomes a significantly less important layer of probability if you're trading an in-play name. So and I don't have any examples for you off the top of my head, but there have been plenty of good shorts, I'm sure, throughout the entirety of this month on stocks that were super weak because they had a bad earnings report and we're in earnings season, and there were trades there. So I think that you can take those trades. My tendency is always still even with the market, even if it's an in-play name. But in-play names are our go-to when the market itself is giving us uncertainty. When we don't know what we want to do from a big picture perspective with the market on a day like today, because we're saying, too extended to buy, not extended enough to short, that's when I love to find an earnings name or something that's got news, NEO and XPEV today as an example. That becomes obviously more difficult as you start getting out of earnings season, which we're just about there. We're just about out of earnings season now. So we're going to have less and less opportunity there if the market itself isn't providing it. But yeah, that's news trumps market trend. Yeah, ideally I still prefer that, but the market trend itself is significantly less important if you're trading a name that's on an earnings report or has any type of real news. Yeah, no problem. No problem at all. Let me see if there's anything in the YouTube, which I haven't pulled up yet. If you're in the YouTube, give me a thumbs up. The alternative contrarian says sometimes the market ignores technicals like it has lately. It's all fundamentals now. I wouldn't fully agree with that. I think the market still has been respecting its technicals. We're seeing record inflows into the queues in recent days. Yeah, for sure. That's what Dimitri's post earlier today was showing us, which does not necessarily mean that we're at the top or at a top even, but it means that we're closer to a top than we were at the beginning of the month. Whew. All right, gang. I think I got through all the questions. Yeah, apple peas over 30. And that's what I'm saying. All those Fang names are like a little bit historically expensive right now. But that's why I feel like some money should be coming out of them as the TLT moves up, but rotating right into the things that are more beaten up, and that we just haven't had that. We haven't had that, and that's, I think, the one thing that frustrated me even particularly today, though I should be smarter than that. So I'll wrap it up. Have a great night, everyone. If you're watching on YouTube, give me the thumbs up. Otherwise, I'll see you all tomorrow.